Hi there, this is Performance Accountancy. My name is Louise Harrington, and the purpose of this video is to talk to you about capital allowances for the self-employed and what exactly are they. So let's kick off with what are they? So tends to be expensive purchases that can be in the business and last a couple of years or more. We normally say over 1 year, but then people get confused whether it's a whole tax year, whether it's just a calendar year. So we put in the fact like it should be used for more than 2 tax years. I have to state it is an allowance, not an expense. And I'll come back to this a bit later. More or less it's one and the same thing, but it's just the general treatment at the end. So there are 2 main types of capital allowances for the self-employed. The first is the annual investment allowance. It is also something called a first year allowance, but basically on the tax return, it's the annual investment allowance. And this gives that you can have 100% allowance in the first year of spend on these type of capital equipment. I will go into what capital equipment is. So you can write it off all in the first year, 100% of it, providing it is below the maximum amount of capital investment you could write off in 1 year. That does vary year by year, and it at the moment has been anywhere between £25,000 and £200,000. So it probably won't apply to most of you, but those people wanting to buy expensive instruments, then you might find you're over the 25k limit. So just check what it is for the tax year you're buying it from. The second type of capital allowance is called the writing down allowance. And that means you can charge your business 18% on what we call the reducing balance value until it is written off to 0. Now, for a car, there are different rules. So that isn't 18%. Some cars are only at 6%. For those type of cars that are gas guzzlers, basically, this covers 6%. So if they've got high CO2 emissions or they're not in the low class CO2 emissions, then you can only have a writing down allowance of 6%. Things like a car would have to be proportionally claimed because a car is often used for business and pleasure, and so you'd have to work out what the business proportion is. So it's a bit too much information in one go, really sorry. So only allowing annual investment allowance of 100% in the first year of purchase, or a writing down allowance which could be 18% or 6% depending on the type of asset. Now, I've said reducing value or reducing balance. What exactly is that? So it basically means you take the value that you purchased it at, you then take off 18%, and 18% is what you charge your business, assuming it's not a car. And that gives you a value you are left with at the end of the year. The following tax year, you take off 18%. But it is only 18% of the tax value and not 18% of the original value. So here you will see that we have purchased, let's say, a violin for £15,600. We want to claim the writing down allowance of 18%. So in year 1, you'll get an allowance of £2,808. The value, therefore, at the end of the year comes down to 12,792. In year 2, you take 18% of that reduced value, so you get a capital allowance of £2,302.56. Brings its value down to £10,489.44. And so it continues at 18% per year. It doesn't actually get written off until year 24. Woo! No. Now, there are other rules you can apply. So if the pool of assets goes down to less than £1,000, you can write them all off. But that's a different story, and it does depend on having a small pool of assets or maybe only one asset in its own pool. but there are different rules for that. But you can look at, oh, my asset pool is below £1,000, I will write it all off. So you'll see it's a nice little curve going down, and it eventually more or less flattens out at the end. Now, it might give you that, but you have to know whether you are eligible to qualify for this. So you must be in a trade, profession, vocation, be self-employed. I am specifically ignoring companies here. So you are registered as a self-employed person or a sole trader, or even a partner in a partnership. You can then qualify if the activity is there. So it might be self-employment, it could be something, a property business. There are special rules for property. A furnished holiday let, you can look at the rules there. There are other videos on these two types of letting. And there are a few other cases where you can claim a capital allowance, but they're not really relevant for the music, arts, entertainment industry. You need to look at what type of asset you are purchasing, so what type of piece of equipment you're purchasing, whether it qualifies for relief, and you can only claim for expenditure that is for the business. So I might decide to go and buy a new washing machine for £600. It will hopefully last me more than 2 years, but it's absolutely nothing to do with my business as an accountant. I don't take in laundry services. Difficulty doing my own. So it has to be for the business. It has to be certain types of expenditure, and you must be in a qualifying activity. So there are various categories on what you can claim allowances on. I'm just going to read this. Plant and machinery, research and development expenditure. If you've got patents on various bits of invention you've had, mineral extraction if you want to go and be a miner, or dredging if you want to go and dredge for certain sort of valuables, etc. But really the only one that affects us is plant and machinery, or you might call it fixtures and fittings, or furniture and fittings, or computer equipment. So that's the type of thing we can go for. And of course, I've moved on to the next slide by accident. So what is plant and machinery for a musician or a performer? Well, there is a nice long list here, but the most important thing is you must own the asset to be able to claim capital allowances. If it's hired or leased, or your parents bought it, or it was a gift, etc., you cannot claim any capital allowances. If it's hired or leased, you may be able to claim the rental costs that you pay each month rather than applying for a capital allowance. So the typical things that you can have as fixtures and fittings or plant and machinery are new instruments, a new computer, a Mac, recording equipment, studio lighting, PA systems, furniture for the office, a brand new printer that costs a bit more than 50 quid. Those ones we wouldn't bother capitalizing. And there is the ability to have a capital allowance on vehicles. Vehicles is not covered in this video, but it is covered elsewhere if you have a search of the knowledge base. So how do you actually claim for having the capital allowances? Well, it all comes via the self-assessment tax return. And part of the self-employment section, there is a bit on capital allowances. And it asks you if you've got anything in the annual investment allowance, or you've got tiny bits that are left over you want to write off in one go. That's the under £1,000. Or other capital allowances is your writing down allowance. But what you must remember, the annual investment allowance can only be claimed in the year that you spent the money or you purchased the asset. I'm going to say purchase the asset because that will be the date of the invoice or the bill from your supplier, and that's the year it goes into. So it's the purchase of the asset that determines which year it goes into. If you are bringing in an asset from, you know, a prior business, or you just set up as self-employed, you would have already had those existing, so you haven't actually paid for them, but you can bring them into your business at the second-hand value, and then you'll be doing a writing down allowance over the next, well, 24 years if you keep it for that long. So you can only claim a writing down asset allowance if you still own the asset. Okay, right. Now, sometimes you sell these assets. You might have a flute, you've used it for a few years, you now want to upgrade the flute to a much more expensive one, so you sell the other flute. So now, there is always a problem if you sell a piece of capital equipment that you have claimed capital allowances on it. So what you look at is the balancing charge, as in, have you sold it for more than its tax value? Okay. Now, sometimes people will pay or claim 100% annual investment allowance, which is fine. You know, a £6,000 joint head has been written off in year 1, and then come year 3, you're selling that joint head. But in effect, it has a tax value of nothing because you've claimed 100% of the allowance. So therefore, if you sold it for £5,000, you effectively have a balancing charge of £5,000 to pay back to the government. You're not paying back the £5,000. You are only paying your tax rate on that £5,000. So if it was bought when you're a 20% taxpayer and sold at a 20% taxpayer, that's fine. You've got equilibrium of you buying and claiming the capital allowance and then selling it, and you'd have to pay back 20% of the sales price. That's all very well, but if you suddenly go into being a 40% taxpayer, you can't tell the system, oh, but I only claimed my capital allowance at 20%, so I only want to pay it back at 20%. You don't. You effectively pay it back at 40%. So that is just something to be aware of. If you are likely to sell any instruments or any assets, etc., after you've put a few years after you've purchased them, don't write them off as 100% annual investment allowance. Just do a writing down allowance. Obviously, if you have a whole pool of instruments and you sell one of them, you can actually deduct what you sold it for from the pool value and just claim lower levels of writing down allowance in the future. That does rely on you keeping very accurate records of what is in that pool, what you are taking out, and the values you are taking out. But, you know, we know tax and accounts is all full of paperwork, so you have to get used to it. But that's the danger. Personally, if you've got something you might sell, don't claim the annual investment allowance. And what I'd also say is, if you've got an instrument that's likely to increase in value or hold its value, consider not claiming any allowance or just a small allowance of the 6%. Just to recognise the fact you are using an instrument, you have purchased it, it's going to have some kind of decline in value. But things like stringed instruments, harps, and yes, I do know harp has a string, instruments like that may not go down in value very much. So consider not writing it off as the annual investment allowance. Just consider a small amount of writing down allowance. That way you'll definitely avoid the balancing charge for when you sell it for possibly more than it's worth. So there is a box in the tax return where you can put this balancing charge. Okay, so finally, this is a big note. Capital allowances only works if you're doing an accounting-based form of your accounts, so what we call the accruals format. If you tick the box to say you are using cash accounting, you cannot claim any capital allowances because you have to account for the cost as an expense in your business. So the fact you might have purchased a flute for £15,000 and your income is only £20,000, you've only got income then of £5,000, which you won't pay tax on. Well, assuming no other income anywhere. So it really is a bit of a waste of capital allowances. And this is one of the biggest reasons why I suggest to people that do buy capital equipment or new instruments never to use cash accounting. Okay, so don't use cash accounting if you can help it. Make sure that if you are doing the annual investment allowance, it's nothing you really want to sell at the end of the year. And think about a writing down allowance of 6% in the special rate category, just to recognise the fact you have bought a new instrument and it's depreciating down. So that's it really. That is what your capital allowances look like. Some people call them capital gains, but that's something completely different. So do not think about that. That's nothing to do with capital allowances. Any problems, feel free to drop me an email. Thanks, Em. Bye.